What is share purchase agreement, SPA? So we'll discuss everything about SPA, share purchase agreement, including its legal provisions, drafting essentials, due diligence, representations and warranties, indemnity clauses, valuation, closing conditions, tax implications, FEMA compliances, and practical negotiation strategies used in real corporate transactions. So in this video, I'll explain in detail because today's corporate startup ecosystem and if you see the mergers, amalgamations or acquisitions, private equity investments and promoter exits, promoter will exit, are becoming extremely common. We are seeing whenever the shares of the company are transferred in a structured transaction. So the most important legal document is share purchase agreement. This is called as a SPA, commonly called as a SPA. So this properly drafted SPA protects the buyer, it protects the seller, it protects the investor, it protects the promoters, and even company itself. Drafting is the most important. One mistake in SPA drafting can lead to huge litigations, tax disputes, fraud allegations, and indemnity claims. So many issues, even regulatory action. So we will try to understand what is SPA and why the SPA is important. What are the key clauses? What are the legal provisions and risk protection, due diligence, tax issues, FEMA implications, and practical drafting guidance we'll discuss in detail. What is SPA, share purchase agreement? Is a legal binding contract entered between seller of the shares and buyer of the shares, through which ownership of the shares is transferred on agreed terms and conditions. So the SPA governs consideration clause, representations, warranties, and liabilities, indemnity clauses, certain condition precedents, and dispute resolution, post closing obligations. These are the most main important clauses. Why SPA is so important? SPA is not merely a transfer document, it is actually a risk allocation mechanism. Commercially, understanding the document and legal protection framework, it protects against the hidden liabilities, any tax exposure, pending litigation, non-compliance, undisclosed debts or regulatory violations and fraud. So we'll discuss the types. There are types of SPS. One is a promoter share sale. Promoter sell stake to another person or investor, or another SPA for merger acquisitions or startup investment transactions. Investors acquire shares through investment rounds. Even in merger acquisitions, acquirer purchase controlling stake. And family settlement transactions, we will see shares transferred among family members. And private equity and venture capital deals, PE, VC funds acquire stake through SPA and SHA. What is the difference between SPA and SHA? There is a difference. SPA is a transfer, purchase of shares. SHA governs the rights. SPA is a one-time transaction document. SHA is the long-term management document. SPA will focus on closing transaction, whereas in SHA, shareholding agreement focus on future operations, shareholder relationship centric, whereas SPA is seller buyer centric. That is the difference. We'll see the legal provisions applicable. Companies Act 2013, Section 44, shares are movable property. Section 56, transfer of shares. and share transfer procedure, stamp duty provisions, register of members. These are all cover under Companies Act 2013. And Indian Contract Act 1872, SPA is fundamental contract. Fundamentally, it is a contract. SPA is a contract. So hence offer will be there, acceptance will be there, lawful consideration will be there, free consent must exist. And FEMA regulations. If non-resident investors are involved, then FEMA, RBI pricing guidelines, reporting compliances, these are all mandatory. And income tax provisions, tax implications arise on capital gains, valuation, withholding taxes, and slump sale characterization, indirect transfer issue. So there are certain key clauses in share purchase agreement. We'll understand that definitions and interpretations. So definitions like sale shares, completion date, and material adverse effect. What is a business day, encumbrance. So good definitions reduce litigation risk. This is the core clause, sale and purchase clause, because it specifies the number of shares, class of shares, ownership rights, transfer obligations. Consideration is an important class. Consideration, one of the most sensitive class. It should clearly mention purchase price, payment mode, timing, deferred consideration, if any, escrow arrangements, earnouts. Improper drafting may trigger tax disputes, recovery disputes, and FEMA issues. Consideration, there are certain condition precedents. Certain conditions must be fulfilled before closing. Example, I'll give you like lender approvals, board approvals, shareholder approvals, regulatory approvals, due diligence clearance. These are all condition precedents. And conditions subsequent post-closing obligations. Examples like resignation of directors once the transfer is over, and updating statutory registers, transfer forms filings, ROC filings, operational handover. These are all conditional subsequents. Then warranties, representations. So extremely important class this is, because this is like seller confirms, buyer confirms. Seller confirms ownership of shares and no encumbrances are there, and legal compliances, tax compliances, no hidden liabilities, no litigation. So if any false statements are discovered later, then buyer can sue for the damages. And there should be an indemnity clause. This clause allocates the risk. So seller indemnifies buyer against the hidden liabilities, tax claims, fraud, non-compliance, or litigation. So this clause often becomes the most litigated part of share purchase agreements. And there is a limitation of liability. Seller usually negotiate the maximum liability cap, time limits, threshold claims, and basket clauses. This prevents unlimited future liability. That is the advantage. And the covenant clause, like pre-closing and post-closing obligations. Examples like a non-compete, confidentiality, and employee protection clause, business continuity clause. And another important clause is a termination clause. It clearly specifies when transaction can terminate, or default events, or breach consequences, force majeure situations. Another clause is dispute resolution. Under this, usually includes arbitration, jurisdiction, governing law, and seat of arbitration. So most SPS prefer Arbitration and Conciliation Act 1996. So due diligence in SPA transactions, generally before signing SPA, buyer conduct due diligence. Types of due diligence, there are legal due diligence, financial due diligence, secretarial due diligence. Then in legal, incorporation, litigation, licenses, contracts, property title will come. Whereas financials, debt, liabilities, current liabilities, related party transactions. Tax due diligence, in that GST, income tax, TDS, transfer pricing, and assessments we need to check. In secretarial due diligence, ROC filings, we will see registers, we will see resolutions, FEMA compliance, SEBI compliance. So there are red flags in SPA transactions. Professionals must identify if any fake valuation, undisclosed liabilities, or litigation exposure is there, or binomy risk is there, FEMA violations are there, or related party siphoning is there, any shell transactions are there. So what are the tax implications on SPA? If you see seller side, potential exposure section 56 subsection 2x, TDS obligations, valuation scrutiny, even FEMA issues in cross-border deals, pricing guidelines mandatory, and FCTRS filings required, sectoral caps applicable, delayed reporting penalties possible. So finally, the practical drafting, some tips like a clearly define consideration. This is the most important. Mention payment timelines also, and the language, strong indemnity language, proper diligence should be there, and attach disclosure schedules, and verify share certificate. Share certificate verification is the most important, and check statutory registers, confirm board approvals. Generally, what are the common mistakes in SPA? Ignoring tax clauses. We have seen some vague indemnities. We also seen some skipping of this disclosure schedules and failure in verifying titles. Many of the cases ignoring FEMA transactions, FEMA compliances, and inadequately defined closing obligations. So, along with the SPA, certain important documents like escrow agreements, disclosure letters, board resolutions, SH4s, resignation letters, and non-complete agreements. So the final conclusion is this is a legal document. It is a backbone of MNDA mechanisms, risk protection mechanism, litigation prevention tool, and commercial safeguard. Professionally drafted SPA can save crores of rupees in future disputes. So my request would be for proper due diligence, legal drafting, tax analysis, and compliance verification, and absolutely these are all essential. Hope you are clear on SPA, and we have clearly explained the difference between SPA and SHA, shareholding agreement and share purchase agreement. Thank you.